Imagine, you're standing in your kitchen right now, opening the fridge door, and there they are, those familiar Kraft cheese slices and Heinz ketchup bottles staring right back at you. These aren't just random items tucked away in your pantry. You know, they're the building blocks of a massive, $100 billion food empire that was born from one of the biggest mergers in corporate history back in 2015. But here's the absolutely crazy part. In just a few short years, that glittering empire lost $15 billion in value, literally overnight. One of the largest write-downs corporate history has ever witnessed, shaking investors, the stock market, and the entire food industry to its core. This isn't some dry, boring number story. No way. This is about unchecked greed, cost-cutting that spiraled out of control, innovation that got completely forgotten in the shuffle, and a company that's still desperately fighting for its survival in 2026. Amid rising inflation, shifting consumer habits, and fierce competition. If you've ever melted Kraft cheese on your burger, or squeezed Heinz ketchup on your fries, or even if you're just curious about how giant brands can crumble so spectacularly, trust me, this story is going to hit really close to home. So stay with me here. We're going to unpack the explosive rise, the massive scandal that exposed all the dirty secrets, the real human cost that often gets overlooked, and whether Kraft Heinz can finally catch up in 2026. Let's dive right in, and by the end, you might just rethink what's sitting in your shopping cart next time. It all started back in July 2015, when 3G Capital, those Brazilian private equity wizards known for their no-nonsense, cutthroat efficiency, teamed up with the legendary investor Warren Buffett's Berkshire Hathaway, and pulled off a staggering $46 billion merger between Kraft Foods and H.J. Heinz. This wasn't just any old corporate marriage. People in the business world called it a masterpiece, a perfect consolidation in what was seen as a stagnant, sleepy food industry at the time. Suddenly, boom, Kraft Heinz became the third largest food and beverage giant in North America, with a powerhouse portfolio of household names that everyone recognizes: Oscar Mayer hot dogs,
Jawa desserts,
Philadelphia cream cheese, Maxwell House coffee, Capri Sun juices, Velveeta, Lunchables, and of course, the undisputed king of condiments, Heinz ketchup. Sales absolutely exploded to over $26 billion in those early years. The stock price climbed all the way to a peak of around $97 per share in 2017, giving the company a market cap that soared north of $100 billion at its absolute height. How did they pull off this rapid, seemingly unstoppable growth? It was all about aggressive, relentless cost-cutting, a strategy that 3G Capital had perfected in previous deals like Burger King and Anheuser-Busch. They rolled out zero-based budgeting, meaning every single expense, from the tiniest paperclip in the office to executive plane tickets, had to be justified from scratch every single year. No assumptions, no free rides. Factories were shut down across the country. Supply chains were streamlined to the bone. They laid off over 5,000 employees in the first few years alone. Advertising budgets got slashed by 30 to 40%, and R&D spending dropped to less than 1% of sales, way below industry averages. To Wall Street analysts and investors, it looked like pure genius, turning these old, legacy brands into highly efficient cash machines, delivering massive profit margins and shareholder returns quarter after quarter. But let me tell you something personal. I still remember being a kid in the 90s, begging my mom for that iconic blue box of Kraft mac and cheese. It was like magic, instant comfort food after a long school day. Who could have guessed back then that those beloved brands we grew up with are being squeezed so hard for profits? That one day, they just burst under all that pressure. The growth looked sweet and shiny on the surface, but deep cracks were already forming. Consumer preferences were shifting toward healthier options. Competitors were innovating left and right, and the company's product pipeline was starting to dry up completely. And then, February 21st, 2019 happened, the day the whole house of cards came tumbling down. Kraft Heinz drops this absolute bombshell announcement, a staggering $15.4 billion impairment charge, primarily on its Kraft and Oscar Mayer brands, admitting outright that the assets were worth far less than what they had valued them at during the merger. This write-down was one of the largest in U.S. corporate history, reflecting overpaid acquisitions, declining brand power, and years of neglect. The stock plunged 27% that day alone, eventually losing 37% in a single trading session, wiping out roughly $16 billion in market value and shocking investors worldwide. Why did this disaster happen? Because the aggressive cost-cutting, it backfired spectacularly in multiple ways. First, they cut marketing budgets so deeply, brand awareness and loyalty started to fade away. Consumers began shifting to fresher, healthy alternatives like plant-based cheeses or organic ketchups from smaller startups. Second, R&D was essentially gutted. No meaningful new products launched in years. Nothing exciting to draw in younger buyers. While rivals like Nestlé and Unilever were flooding the market with innovative lines. Third, the company faced supply chain disruptions and commodity price hikes. Things like dairy and tomato costs spiking, that their ultra-lean model simply couldn't absorb without hurting quality or profits. The SEC later launched an investigation and fined the company $62 million in 2021 for misleading investors about those so-called cost savings and for not writing down impaired assets on time, a clear case of accounting tricks to prop up the numbers artificially. Executives like former CEO Bernardo Hees came under intense backlash. He stepped down in 2019 amid the fallout, and the board faced multiple shareholder lawsuits accusing them of negligence. My uncle, who worked in a local food distribution warehouse for 25 years, used to say, "You can only squeeze a lemon so many times before you're left with nothing but bitter rind, and that rind is really tough to swallow." And for Kraft Heinz, that rind was incredibly bitter, not just for shareholders, but for the entire company culture. Now, let's fast forward to today, February 2026, and Kraft Heinz is still reeling from those deep wounds. In their latest Q4 2025 earnings report, released on February 11, 2026, the company reported organic net sales down 3.4%, volume down 4.1%, and a net loss driven by continued impairments and restructuring charges. The stock is hovering around $24.40 per share, a far cry from its 2017 peak, down over 14% in the past year alone, amid rumors that Berkshire Hathaway might sell off more of its stake. New CEO Steve Cahillane, who took over in 2023, recently paused long-discussed plans to split the company into two separate entities, one for snacks and one for meals, and instead committed $600 million in incremental investment toward marketing, product innovation, and supply chain upgrades. Analysts are a mixed bag. Some see it as undervalued at a 61% discount to fair value, with 2026 EPS guidance between $1.98 and $2.10, a slight uptick from last year but still below pre-pandemic levels. Others remain cautious due to persistent headwinds like high debt loads exceeding $20 billion, inflation squeezing profit margins, and weak consumer demand in a market that's increasingly health-conscious and budget-tight. But let's talk about the real pain. Behind these cold, clinical numbers lies the true human toll. Over the past decade, thousands of layoffs have hit hard, from factory workers in Illinois and Wisconsin to office staff in the Chicago headquarters. Entire communities have suffered as plants shut down, leading to local economic ripples like lost jobs, reduced tax revenue, and empty storefronts. I came across several anonymous Reddit posts and LinkedIn stories from former employees. They told us the cuts were temporary to streamline operations, then the plant shut down overnight. We lost our health insurance, pensions, and had to start over from scratch. It's truly heartbreaking. These are real families, veterans of the food industry with decades of loyalty, affected by decisions made in distant boardrooms chasing quarterly earnings targets. In 2026, with ongoing restructuring and potential more cuts if the turnaround doesn't stick, even more jobs could be at risk, adding to the human side of this corporate saga. So, the big question: can Kraft Heinz actually recover in 2026 and beyond? The odds are mixed, but there's a glimmer of hope. That $600 million reinvestment in marketing and R&D is a critical step in the right direction, something rivals like PepsiCo did successfully after their own portfolio challenges, pivoting to healthier snacks, beverages, and sustainable packaging to win back consumers. If Kraft Heinz can launch innovative products, think plant-based cheeses, low-sugar ketchups, or eco-friendly packaging, and rebuild that lost brand loyalty, analysts predict a hold or buy rating for long-term value investors, with potential stock targets climbing up to $30 to $35 by year-end. However, short-term headwinds remain strong: rising ingredient costs, fierce competition from private label brands at Walmart and Costco, and a broader consumer shift toward organic, sustainable options that big processed food giants like Kraft Heinz are struggling to match. The big lesson for entrepreneurs, founders, and investors watching this: aggressive cost-cutting can look great on paper, boosting short-term profits and pleasing Wall Street. But if you starve innovation, marketing, and your employee morale, eventually, your brand equity dies, and long-term growth evaporates. You can't run a food company, or any business for that matter, like a private equity spreadsheet forever. Real people, changing tastes, and market realities matter way more. What do you think? Can Kraft Heinz turn this around? Or is this another legacy brand heading for irrelevance, like Blockbuster or Kodak in their time? Drop your thoughts in the comments below. Have you noticed fewer Kraft products in your local store lately? Or have you switched to healthy alternatives yourself? If this breakdown helped you understand how big brands can fall so spectacularly, hit that like button, subscribe for more in-depth business autopsies, and turn on notifications so you don't miss the next one. Thanks for watching. See you in the next video. And hey, maybe check your fridge for those expiration dates. Stay smart out there, and keep questioning the big companies.